When it comes to investing into an ETF, the cost can be a great consideration because, as we know, the fees can eat up the value of your portfolio when holding it for the long term. However, are fees the only consideration that you should make when investing into an ETF? In this video, I'm going to explore an ETF which is actually more than 3 times cheaper than the Vanguard Footsy All-World. As you can see, this is one of the most popular all-world funds on Trading 212, and that is the Vanguard Footsy All-World. You are probably either investing into it already or definitely have heard of it. Now, this fund has an expense ratio of 0.22%, which, if you're not comparing to any other fund, is actually pretty cheap to have allocation to most of the world's stock market. We are looking at the distributing version here, which actually pays out dividends, but of course there is also the accumulating version, and as an investor, it is up to you to decide which one you want. Now, if we go into the top 10 holdings, we can see this has a huge weighting towards the US, Apple being at 6.27%, which is pretty high. We also have Microsoft at 3.6%, Nvidia at 3.28%. Now, when we switch to a country view, we can see that the United States of America has a very heavy weighting in this ETF. So US being around 63%, Japan being around 6%, and then we have the UK, China, France, Canada, Germany, Switzerland, India, Taiwan, and a few other countries. Now, in my opinion, a good world fund should encompass, a significant portion in the developed markets, for example, UK, US, Japan, and also should have exposure to developing markets such as China and India. This is because combined, China and India have a huge population, and you'd be pretty silly as a world investor to not invest into a population the size of around 3 billion people. Now, this is the fund that I'm talking about that is significantly cheaper than the Vanguard Footsy All-World. It's called the Amundi Prime All Country World Distributing Fund. The reason why I showed the Vanguard distributing version is because this fund is only available as a distributing fund. Now, of course, I'm using my Trading 212 account to show all of these videos, and if you would like to sign up to Trading 212 and receive a free fractional share worth up to £100, all you have to do is to click the link in the description box down below. Alternatively, if you've already signed up to Trading 212 in the past 10 days but have not received your free fractional share, all you have to do is to click the 3 horizontal line menu over here. Scroll all the way down until you see the section Use Promo Code. And in this section, just enter my code JUBAIR and you should receive a free fractional share. So going back to this fund, it has the ticker code PACW and it's by Amundi, which isn't the most well known when it comes to ETFs or fund managers. And in fact, we're actually going to find out a little bit more about the company just to show you that the fund manager that you're investing into might be an important consideration if you are a long-term investor. Now, because this is a very new fund, it does not have many performance figures. On Trading 212, this fund was first introduced on the 31st of March, so we have very little data to work on. Now, as you can see here, the total expense ratio is only 0.07%, which is actually the same price as something like the Vanguard S&P 500 or even the iShares S&P 500, which is actually crazy to think with the same price you're getting an all-world fund, which is of course going to be a lot of the S&P 500 plus exposure to many countries around the world. Now, this puts it at over 3 times cheaper than the Vanguard Footsy All-World, and in my previous video I did show that there were cheaper options than the Vanguard Footsy All-World, and you can go and check out that video over here. Even though this is a new fund, you can see that the assets under management are already pretty high at 2 billion, which is very impressive to see. Now, I won't go over annualized performance as I don't believe we have enough data, and also past performance does not really indicate any future growth now, does it? But anyway, let's go into fund allocation and see what we're invested into. So as you can see, it is going to be different from the Vanguard Footsy All-World because the top company is not Apple. And in fact, Apple only has a 3.76% weighting here. The top company is Microsoft at 4.32%, and then Nvidia at 4.08%. I personally wouldn't actually pay too much attention to the company exposure, but more the country exposure. This is because even within the S&P 500 index, some companies do better than others, and their market cap increases a lot. For example, Nvidia and Microsoft recently have seen quite a boom. So I don't really look too much into sectors either, because realistically there could be overlap. There's technology, financials, industrials, but as long as you are getting a nice mix of sectors, then in my opinion, you don't have too much to worry about. But of course, being an all-world fund and not a thematic world fund, we should be fine in terms of sectors. Now, here is the breakdown in terms of country, and again, it's extremely similar to the Vanguard Footsy All World. So you're getting about a 63% weighting in the United States of America. Japan, almost identical to the Vanguard Footsy All World at 5.7%. In the UK, you're getting around 3.39%. China is actually a heavier weighting in this fund, which I like to see. Of course, China being the second largest economy, it stands to reason you'd want to, invest into that a bit more. We also have Canada, Germany, France, Switzerland, and importantly, countries like India and Taiwan. So it's really good to see that you actually have a lot of exposure to the world's markets. So on paper, this looks great. Why wouldn't you want to invest into a fund that seemingly on paper looks almost identical to the Vanguard Footsy All World, but you're paying over 3 times less of a fee compared to the Vanguard counterpart? So who exactly are Amundi, and is that actually how you pronounce it? Well, unfortunately, I can't speak French, so I'm going to have to just say Amundi. But here is a bit more about the company. So apparently, Amundi is a #1 European asset manager, and it is one of the top 10 asset management companies in the entire globe. They have over 2.2 trillion euros in assets under management, with more than 100 million retail clients. So their headquarters is in Paris, and the company Amundi is also traded on the stock market. However, if you do a bit more digging, you can see that the company has been fined in the past. And as you can see here, in 2014 and 2015, the company was actually found out to be misusing information pertaining to pending orders in order to increase their profits. So the company had to pay a hefty fine, and this kind of really taints their reputation. Now, although they are providing this fund for a significantly cheaper price compared to, the likes of Vanguard and even iShares, they have been found to misuse information previously, and if they do it again and amass another fine, you just have to think where cuts will be made within the company in order to pay for these very large fines. Now, unfortunately, when it comes to investing into ETFs, the fund manager plays a huge role, and essentially, if the fund manager is not cooperating or mismanages the funds for whatever reason, then your investment could be at a further risk. Now, I'm not saying Vanguard and BlackRock don't have their fair share of controversies. Every single asset management company will be. But as an investor, reputation really matters. And a lot of the times, people will pay the premium just for that extra ease of mind that their, funds won't be mismanaged, even though technically your capital is always at risk, as the underlying assets can always underperform. So make sure to check out some of my other videos, and I'll see you in the next video. Are fees the only consideration that you should make when investing into an ETF?